I'm Cindy Padnos, and I'm the founder of Illuminate Ventures. We're a micro VC fund focused on early stage cloud computing and enterprise software companies. And we do indeed have one unicorn company in our portfolio. It's an unusual company in the sense that they're not just a multi-billion-dollar valuation, but also generating multiple billions of dollars in revenue. So a very interesting company. And Eric, would you like to introduce yourself?
Sure. And I'm Eric Benhamou, and like Cindy, we're also in this micro VC space. We have a small sub $100 million early stage enterprise IT fund. And we focus on very similar sectors because we think they're fruitful of innovation, including cloud-related companies, cybersecurity, mobility, and IoT. We think that in all these sectors, the innovation landscape is ripe for new companies to emerge and to displace incumbents and for value to be created. Sometimes this value can reach the thresholds of unicorns, but even if it doesn't, we think LPs can get extremely good returns just by being able to ride value creation from the ground up.
So in terms of looking for unicorns, I don't think most investors go into an initial investment assuming that the company is going to be a unicorn. And in particular, in a small fund, that is not necessarily the objective, because what you have to understand about unicorn companies is that they're not just unicorns in terms of the valuation, but they're also raising gigantic amounts of capital. And that capital creates dilution. That capital also can delay outcomes for a company. And so it's an interesting set of trade-offs I think we face as we consider whether being a unicorn is a positive or a negative. What's your perspective?
Yeah, I agree with this view. The phrase unicorn brings together a whole bunch of different companies who have, some of them are true, authentic unicorns in that they're fundamentally disruptive and they're addressing really big markets and they deserve the rich valuation that they enjoy. And others are pretend unicorns that are very fragile and could collapse at the slightest downturn. When we spot early stage investment companies, we don't ask ourselves the question, is this a unicorn or not? It's not like they have truly a unicorn planted in their forehead. What's different is that if these companies have fundamental technology innovation that connects to really large markets, then they have the potential to be a truly disruptive force and for valuations to extend. But again, early stage funds are not really in the business of unicorn hunting. They're in the business of creating value for their LPs. And you don't need a unicorn to create value. In fact, I would even submit that unicorn hunting is a complete fallacy.
Well, I would say in the enterprise space in particular, and I think to say you're a unicorn hunter probably suggests that you know all of the attributes of a unicorn. The research I've seen, the data I've seen suggests that unicorns are mostly founded by first-time entrepreneurs, which is fascinating because you can't pick those out randomly and say, well, it's a serial entrepreneur, I trust them, I know they're going to do this. They're mostly founded in the consumer internet world where there are extremely large markets, and they're mostly founded with companies that are doing something completely disruptive that no one can predict. So to suggest that there's a way to identify upfront a company that's going to be a unicorn, I think is suspect, to say the least. Now, I mentioned we have one unicorn in our portfolio. It came about in a very interesting way. We originally invested in a company that was a predictive analytics platform for online and cross-channel retailers. That company merged 2 years after its inception with a company that has gone on to become a multi-billion-dollar unicorn, a company called Coupang. And that came about because Coupang, in fact, was their largest customer. And when this company had some other exit opportunities that were presented to it, Coupang was just a much more compelling relationship. And the result is now the combined companies have both an unbelievable technology base that was brought to it by our company and an unbelievable market capability and presence in Korea. They're the largest e-commerce player in Korea and have grown to be that in just a 5-year period, which is incredible.
So there's substance behind this one.
There is, indeed.
Most unicorns only belong to this group because they have reached a valuation based upon the most recent equity offering.
That's right.
That places them above the $1 billion mark. The problem about this is that these valuation levels are somewhat artificially created to create a spot in the cap table for the late entrants.
Right.
And many of these late entrants, in fact, have terms associated with their investments that make their equity investments more debt-like than equity-like. So in reality, there's a lot of air in this cap table that can go out in an instant.
That's right. I think it's really interesting because we talk very frequently about the impact on investors, both the early stage investors and the late stage investors, when these unicorns raise these very large rounds with the preferences, the liquidation preferences that may be in there that are the debt-like mechanisms you mentioned. The interesting element that people don't think nearly as much about is the impact on the employees, on the founders and the team, the people who, if they leave, there is no company. And I've seen this happen in several companies recently, and I've talked to some of the senior executives and said, well, what are you doing now that you've been marked down and you've brought employees in at this much higher valuation in companies that maybe have gone public and their stock is underwater? This has happened in the past as well. The question is, what do you do? And they're struggling. There's no question that the impact is much more than just an LP who may not see quite the return they expected. It's also fundamentally on the core of the business and the employees of the company.
Yeah, that's so right, because when you receive a big slug of capital, you have to, at the same time, raise the bar on exits.
That's right.
And oftentimes, one of the more responsible duties as a board member of a young company is to figure out the right amount of capital. It should be enough, should not be too much.
Right.
Because when it's too much, it creates side effects which are highly undesirable, including compression of employee equity and employee motivation.
That's right.
So today, companies are staying private a lot longer than they used to, maybe 15 to 20 years ago. In those days, it was a goal to reach an IPO milestone, in part to be able to have access to public equity capital. And there were not too many alternatives if you really needed access to that capital. Today, many alternatives exist. There's a lot of private capital available to fund companies late into their early life cycle. And at the same time, going public is a much more complex and onerous proposition from a regulatory standpoint. So despite the recent ameliorations associated with the Jobs Act, still it's expensive for a company to go public, and it's risky. It's risky in the sense that when you're exposed to broad markets, particularly if you have received rich valuations on your last round of equity, your valuation may actually come down. It's also a liquidity event, which perhaps can reduce the motivation of some of the key employees. So it has to be approached very, very carefully. The net effect is that today a company probably stays private 8, 9, 10 years perhaps, even if it crosses the threshold of critical mass to be able to go public. Because staying private is actually a more attractive proposition, at least for 2-3 years longer than before.
Yeah, you know, we're fortunate in our portfolio to have two companies that in the last 12 months have actually had to make the decision, do we go public or not? One of them chose to, the other has delayed. And I think one of the things that enables that is that our portfolio is made up primarily of companies that are software as a service, SaaS companies with recurring revenue streams. And so every year when they go into the year, they know where anywhere from 80 to 90% of their revenue is coming from these recurring contracts. And they, you know, because they have very low attrition rates, very low churn as we call it, they're able to be very reliable and predictable in terms of their revenue streams. That helps them in terms of making a decision to go public because they have predictability in their revenue, but it also helps them to make a decision to stay private because it's very easy to raise debt capital and take no additional equity dilution in a situation where you have a company that can actually predict the revenue. So banks are very willing to lend capital to those companies. They're able to reach break even when they get to, say, a $50, $60, $70 million kind of recurring revenue threshold and still have very nice growth rates. So one of our companies exactly took the initiative to go public last year, in June of last year on the New York Stock Exchange, very successfully. What's interesting to me is that I don't think that would have been possible without the Jobs Act. the ability to keep all of their data private until the moment in time that they were really ready to go out changed our decision-making process. Now, I agree with you about the complexity. This is the first company that I've sat on the board of as we went public, and it was amazing. The other company will do extremely well. We'll wait a little longer for its outcome, but has created what I guess I would call optionality. It's their choice. They control their own destiny as to what the timing will be.
But the good news is that today capital formation is far more efficient than 2 decades ago. There are lots of options available to companies who reach a critical mass of revenues and a more predictable business model. Mm-hmm. They can afford to delay it a few years, but they don't have to. Right. This is actually a good thing overall.
Right.